All right, everyone. Well, welcome in. We're here with some really, really interesting pieces on our markets and economy update. We're going to be spending a lot of time talking about interest rates, inflation, bond market, but most importantly, just some really stellar performance in the U.S. equity markets year to date and kind of what's driving that. We'll do a quick introduction and then we'll dive right in. I'm Jarrod Musick. I'm the CEO here at Destiny Capital. I really work closely with our client service teams on all of the planning and strategy that we do, but also as a thought partner for Tim on our investment committee. Tim,
Yeah, thanks, Jared. As Jared mentioned, I am the CEO or CIO, excuse me, of
taking
Destiny
my
Capital.
job today. I
Big
love it.
promotion, yeah, big promotion. The CIO of Destiny Capital here, where I do lead our investment committee. That's where we, conduct capital market research. We do manager selection, fund due diligence, portfolio construction, and we work really closely with our client service teams in executing the investment policy statements of our investors. And we do webinars like this and content for our investors so they can understand what's going on in the economy, what's going on in the market, what we're looking at, and how it might impact their portfolios. So, yeah, as Jared said, we've got some interesting stuff to discuss today. So, I'm excited to get into it.
Yeah, let's do that. Leading with the really over-the-top good news here, U.S. equity markets are just they're having a moment here. I mean, earnings growth year over year of 50%, just
Yeah.
absolutely crazy and really broad-based. Tim, do you want to kind of walk us through what we're seeing in terms of why this has been such a broad rally and why we're seeing such strong underlying performance kind of across the board?
Yeah, let's just start with some of the numbers here. And, before we hopped on this call, I was telling Jared, usually we have a mix of good news and bad news in these webinars. And we thought we'd start with some good news this time. And clearly, what we're seeing as far as earnings season in Q2 of 2026 is definitely in the category of good news. It's really been one for the record books when we're looking at what we look at in earnings season, which is revenues, earnings growth, and profit margins. That gives us a sense of how healthy corporations are, if they're growing, if they're contracting, and clearly corporations appear to be very, very healthy. And when I talk about the market, what we're talking about here is the S&P 500. So that's what we're talking about as far as earnings season is concerned. So looking at revenues, looking at sales. So the revenue growth rate for the S&P 500 was a staggering 15%. That's the highest growth rate since Q4 of 2021, and well above the 9.5% consensus estimate when we were heading into earnings season now. So smashing it across the board in every regard, but revenues coming in very, very strong, which is heartening to see. Then talk about earnings growth, and this is the number that really jumps off the page here when we look at year over year earnings growth for the S&P 500. That earnings growth rate, and you can see this in the chart to the top right of the page here, earnings growth rate, as Jared said, came in at 54 or 50.4%. That is just an eye-popping number. There's no other way to put it. It's something I haven't seen before, really as long back as I could think. At least in a period where we weren't coming out of a recession, coming out of a downturn. If you think about what was happening in the financial markets and what quarterly earnings we're looking at a year ago, earnings were very strong. So it's not like we were coming in out of a dip. And you can see that in the middle of this chart here at the top right, where we had a dip and then we had a surge of about 90% coming out of that for earnings growth. That's not what's happening here. It's strength upon strength is what we're seeing here, and that 50.4% earnings growth number just really knocks it out of the park. Then we look at the chart to the bottom right where we talk about profit margins. Profit margins continue to expand. They've been strong quarter after quarter for quite some time now, but we're also seeing record profit margins of 16.9%, nearly 17% profit margins for the S&P 500. And you can see historically, over the recent years, profit margins have been anywhere between, let's call it 10 and 14%, but we've really seen it break out over the last few quarters in hitting this 16.9% number. So
Mhm.
Jared, anything else you wanted to hop in and add before we kind of look under the hood of some of those numbers and where they're coming from and what they might indicate?
Yeah, I mean it's just staggering, and I think for us to monitor this data on a fairly close basis, you use the term eye-popping, and it really is. So I think the takeaway here is that large U.S. companies are pretty extraordinarily healthy right now. They're able to command the prices that they want on their goods and services. They're able to build those in and have them produce profitability for them, so they're not just burning more cash to be able to chase more top line revenue. They're growing revenue and profitability at the same time. But yeah, I would love for you to talk us through what the number of sectors that are showing positive revenue growth and kind of what that means as far as how broad-based this is.
Yeah, yeah, that's what's really different over what we've seen in previous quarters and previous years. You've heard us talk, month after month about the Magnificent Seven companies, the top 7 to 10 largest companies in the S&P 500, really driving earnings season. So driving revenues, driving earnings growth, and driving profit margins. We're seeing the benefit more broadly felt across sectors and across the market this time. So that's what's really different here. So when we look at revenues, all 11 sectors reported positive year-over-year revenue growth. So all sectors are participating in that revenue growth on a year-over-year basis. Earnings growth, yes, it was heavily influenced by two key stocks, Alphabet and Amazon. They had one-time events that caused earnings to really jump off the page for them. But even if you strip out Alphabet and Amazon from the earnings growth number, you'll still see a very healthy 32% year-over-year earnings growth, not including those two stocks. So, you know, over 50% with those two stocks, still over 32% without those stocks. Very,
Mhm.
very, very strong numbers. And then when you look at earnings themselves, really only one sector, and that was healthcare, reported an earnings decline. Um, I think, yeah, I think the story here is that this is more broadly felt across sectors, across the S&P 500, which is a really good thing for the stock market as a whole. We are top heavy in the S&P 500, but we're not, if other companies are participating, we're not as reliant on 7 to 10 companies. There's not that level of concentration risk that we've really felt uh, in the success or failure of the stock market that we felt, over the last 2, 3, 4 years as the Mag 7 has really driven returns, driven earnings, and so forth. And then, as investors, we're also forward looking. That's great. That's great. That's Q2. That's in the past. What's going to be happening down the line? And I think it's important to note as we look ahead for Q3 and Q4 of 2026, we are having an unusually low number of companies reporting negative guidance moving forward. So they have a negative output or negative outlook moving forward. That's a low number of companies that are reporting that. That's a good thing. That means that more companies have a positive outlook going forward. And then when you look at consensus estimates for earnings growth in the quarters ahead, they are also very, very strong. So looking at 27.4% in Q3 and 25.2% in Q4 as far as expected earnings growth in those quarters. So great quarter is behind us, but even moving forward, there's a lot to look forward to. It remains to be seen if we hit those numbers, but markets have been surprising us on the upside for quite some time now, so it wouldn't surprise me to see that happen again. Jarrod, anything you want to add there?
No, I think we're moving forward into our good news sandwich here. It's kind of like a compliment sandwich. So we're starting with some good stuff. Now we're gonna hit a little bit of the bad stuff. But stick with us in about 10 minutes. You'll get the other side of that sandwich. So we have
Yeah.
some stuff to close out with as well. Um, Interest rates and government spending. I mean, this is just the conversation that never ends for us. We talk about it virtually every month. But we are seeing some new data and kind of the new Fed chair has a different attitude about what we're seeing out of the bond market. So, Tim, do you want to talk to us about what Kevin Warsh has really communicated in terms of what he wants to see and what he views the role of the Fed to be, and then, what we're seeing in interest rates right now?
Yeah, it's been really fascinating as we've shifted from Jerome Powell to Kevin Warsh and their kind of disparate philosophies on communication, or in the case of Kevin Warsh, the lack thereof. if you could just read the post FOMC meeting statement from Jerome Powell and Kevin Warsh and put those side by side, and you'll see a stark difference in communication style, transparency, and so forth. And that's something that investors are really having to become accustomed to. It's a change. So what we're dealing with now is a little bit less certainty from the Fed, and we're dealing with other headwinds as it relates to inflation, labor market, and government spending. So while we talked about what was great in the financial markets, in the stock market in particular, we're kind of moving, as Jarrod said, into the challenging areas, into some of the headwinds that we're seeing that could be in the path for investors in the quarters ahead. So, really, Warsh has this philosophy of let the market figure it out. It's not the Fed's role to dictate, and predict and be overtly predictive as Powell tended to try to be in telling investors where interest rates are going to be, what's going to happen with GDP growth, what's going on with inflation data, because as we know, the Fed's often wrong. So I think in the view of Warsh, he doesn't see the essentially the use for that, the predictive nature of what we had seen from the Fed in recent years. So he's got the let the markets figure it out kind of mentality, and that's a challenge for the markets because now they're in that position where it's like, okay, we've got to review this data for ourselves, make determinations on our own, and position accordingly. So that's challenging. And speaking of challenges, we look at inflation. Inflation has remained stubbornly high with CPI at 3.4%. Yes, it's come down a little bit, but we're still dealing with closure in the Strait of Hormuz, energy prices surging higher, coming lower. That's just been a source of volatility that's been challenging for the economy and financial markets as well. We've got the labor market showing cracks. It's been somewhat resilient, but still, we had 23,000 jobs lost in July. And then this is something else that's impacting, and we'll get into interest rates on the next slide. But we're seeing, a surge in government spending, and we talked about this ad nauseum in these webinars about the ballooning government debt, how untenable this really is, and are we going to see, as Kevin Warsh wants, are we going to see bond market investors step up, and start dictating where interest rates should be, and will that potentially impact government spending moving forward? So when we look at government spending, we've got a few charts here. On the top right, you can see total U.S. debt at approaching $40 trillion, approaching that very quickly based on the pace of spending. We've had 2.85 trillion, excuse me, dollars of debt added over the past trailing 12 months. We had a record monthly deficit for the month of July, and you can see that in the chart to the bottom right of 432 billion dollars. And then we've got a 7.8 billion average daily increase in the federal debt. So, yeah, how long can the government continue to borrow at this pace? We're going to see, the cost of servicing that debt continue to rise, especially as interest rates, the 10 and 30-year treasuries continue to increase as we've seen. That's going to become even more challenging. So, Jarrod, before we go into the interest rate story here, anything else you wanted to add?
Yeah, I mean, we continue to talk about this and we continue to view that there's no easy solution here. And we're probably headed toward, some type of event that will force all of us collectively to deal with government spending and debt. And it's probably going to be a combination of, entitlement spending, which is Medicare, Medicaid, Social Security. Those programs are going to need to be reconfigured in some way, shape, or form, just because they occupy about 2/3 of the federal budget. So they're just so massive. Something's going to have to be done there. So we don't know what that looks like, but we do know that, for people concerned about, hey, I'm a current retiree or soon to be retiree for Social Security and Medicare, probably at the bottom of the list of people who are going to be impacted. Definitely younger workers, higher income employed people, things like that. We're likely to see changes in contribution rates, tax policy, stuff like that. There's probably going to be changes to tax policy. And then, with interest cost on the national debt at about 15% of government spending right now and rising, we're going to need to see some changes around borrowing going forward. So we continue to not know what that's going to look like, but from a planning perspective, that's why being, flexible with your capital, being liquid, being able to make different decisions, being able to pivot into different assets at some point in the future. And this could be 10 years down the road or 10 months down the road. But we all need to be flexible and nimble in what we're doing with our capital. And that's part of our investment planning process that we work so hard for on this side. So let's definitely toggle over to interest rates. So I said there was a little bit of the other bread on the good news sandwich here. We do have it, but there's a little more meat in the middle on interest rates to get through before we get to the good news again. So, Tim, where are we at with long-term treasuries, and what is that telling us about the feedback loop inside the global bond market? Is it working? Is it doing what it should be at this point?
Yeah, I guess it depends on who you ask and who's asking. But yeah, we've seen, and our investors are going to hear a lot more about this, especially if interest rates, the long-term interest rates, the 10 and 30-year treasuries continue to rise and move higher from here. But in recent months, really since the advent of the war in Iran, we've seen interest rates, long-term interest rates start to surge. So we've got the 30-year US Treasury rate having moved from about 4.6% months ago to about 5.3%. And those are levels that we haven't seen since the great financial crisis. So, really, what is that telling us? To me, it tells us two things and more, but two main things. It's that inflation, bond investors, feel that inflation is going to be a little bit stickier than the Fed is predicting, perhaps feeling that 2% target is untenable over the long term. Maybe we're going to see higher inflation, which, of course, investors are going to they're going to be wanted to be compensated for that. And speaking of compensation, investors are demanding higher rates due to the fiscal health of the United States as an issuer. That goes back to what we talked about on the prior page. If you look at the fiscal health of the United States, it's deteriorating. We continue to borrow. Interest to cover that debt is eating up more and more of our federal budget simply to service that debt. And at some point, that's going to be untenable. And therefore, investors are saying, hey, I'm going to need 5.5%. I'm going to need 6% to take on that risk and lock that in over the next 30 years, right? So compensation is going to be had, and that's why we're seeing rates move a bit higher on the longer end of the curve. Is the system working? I think if you ask Kevin Warsh, he would say, yes, this is a sign of the system working as he sees it as Fed chair. It's up to the market to dictate where interest rate policy should be. Yes, the Fed controls the short end of the curve, but the market should dictate where interest rates are on the longer end of the curve when we talk about 5, 10, 30-year US Treasury rates and so forth. And when we think about even the short-term rates, when Warsh came on as Fed chairman, there was a lot of hope among certain investors that we would see rates move lower. He was in favor of cutting interest rates in previous years as they moved higher. And I don't think we're in line for rate cuts in 2026, to say the least. In fact, markets are projecting the opposite. Markets are projecting about a 68% probability of at least one rate hike by year end, potentially two, but at least one rate hike, 25 basis point rate hike between now and year end. So markets are saying higher interest rates are going higher and potentially even higher on the longer end of the curve unless something changes there. But so what has that impacted in client portfolios? Well, obviously, the stock market has done quite well. We've talked about that on the first slide here, but bond markets have struggled on a year-to-date basis. They have just recently moved into negative territory, at least when we're talking about the Bloomberg U.S. Aggregate Bond Index. That's down about 0.5% on a year-to-date basis.
And
But not
and
all is.
here's the good news. We're there. Thanks for
But
sticking with
wait,
us.
there's more. This is yes. But wait, there's
Yeah.
more. This is where, I feel like Destiny Capital's philosophy around fixed income and allocating to fixed income as an asset class really shines because while we believe that in equity markets, in the stock market. We believe in index-based investing, low cost, highly efficient index funds. Uh, we're not trying to beat the market. We don't believe that active management can beat the market, beat the S&P 500 or the underlying index over an extended period of time. However, we believe differently when it comes to fixed income markets. We do believe that active bond managers can navigate fixed income markets because they are inefficient and therefore identify opportunities that others might miss, opportunities that really don't exist if you're an index only investor in fixed income. So you see this in the chart to the bottom right that shows the actively managed funds that are in Destiny Capital client portfolios. Not all Destiny Capital client portfolios, but a lot of them. We'll see these tickers are familiar. In the blue line, you see in the blue line you see the aggregate bond index, and you see that's negative here on a year-to-date basis. But then you see our other credit funds, both private and public credit funds, up anywhere from 3 to 5% on a year-to-date basis. So for those folks who are in a portfolio where they have 40%, 50%, 60% allocated to fixed income, whereas they might be flat if they're doing or negative if they're doing index-based investing in fixed income. Just by adding the right active managers and identifying those active managers, that could have a significant impact on portfolio performance um, outside of equities. And we've seen that on a year-to-date basis in client portfolios here at Destiny Capital. So that's been encouraging, and it's been a trend that we've seen through previous difficult market cycles for bonds as well. So even in 2022, our active managers performed very very well, even when, especially relative to the aggregate bond index, when the U.S. aggregate bond index at one point declined 18% on a year-to-date basis in 2022. So yeah, that thesis holds strong here at Destiny Capital, and one that we're excited about.
Yeah.
Anything you wanted to add to that, Jarrod?
Yeah, I mean and this is in flux over time as
Yeah.
well, right? Like there have been periods in time when we've heavily utilized index-based investing for fixed income. There are times when it may make sense to own individual bonds and hold them to maturity. And there are definitely use cases where, we build those out for clients, whether that's a municipal bond strategy because we have a specific income and tax objective that we're trying to meet, or, other types of fixed income that we might hold. But as a general rule, as he said, Tim, the active management is something that we've really seen that has improved returns over the last few years, and we expect that to continue going forward. So it's great to be able to look at indexes and see, here's what's happening. But I think for us, we really want to look at and what's the impact for individual clients and how do we generate what we're trying to generate on your behalf. So thus endeth the good news. And I think overall our webinar for today. So Tim, would you have any takeaways for our viewers here as we kind of wrap up? Anything that you'd want them to hold on to going forward?
I think, if you look back over the last, let's call it 3 to 4 years, it's been quite a ride, especially for the stock market. We've seen strong returns for the S&P 500 year after year after year. It's easy to become used to those type of returns on a year-to-date basis or year-over-year basis, excuse me. But I think it's important to level set a little bit. What we've seen as far as stock market returns has been welcome, certainly, but not something everybody should get anchored to when considering on a forward-looking basis when thinking about stock market returns, what you can expect from your portfolio. Clearly, the markets are doing their part based on what we saw in earnings season. There's a reason that the markets are doing really well. But there will be a time, and there's always a time when we see a downturn. You don't want to get too far ahead of your skis in times where markets are moving higher. It's important to remain balanced and disciplined. Enjoy the times when they come, when markets are performing well, but don't get too accustomed to them and know that another downturn could be around the corner. And that's why diversification and asset allocation across a variety of non-correlated asset classes really adds value over the long term. And that's where we try to stay focused as investment managers for our investors.
Yeah, that's a great leave away item.
Yeah.
Thank you. And I think for everybody, thanks for giving us so much of your valuable time today. Please head over to destinycapital.com. If you don't already work with us and you'd like a portfolio evaluation, an analysis of what you're currently doing versus some ideas that we would have for you, we're certainly happy to do that. We book a 30-minute call. We're able to go through that process. So feel free to head over there. For everybody that already works with us, we are deep into tax projection season as we look at tax strategies for the back half of the year. So be on the lookout for, different transactions inside your portfolio and for us to potentially be reaching out for additional meetings and conversations if there are any things that we need to bring up and flag for you. And then last plug, if you have ideas or questions for future episodes, destinycapital.com, submit those into the CIO mailbag, and Tim and I will definitely add them and be able to address them in the next episode going forward. So thanks again for so much of your valuable time, and we'll be back with another edition next month.
Thanks, everybody. Take care.